Good evening. Thanks for tuning in to Editorji. I'm Avni Raja. We've got a host of experts lined up to decode, to analyze, to assess the impact of Budget 2023, which incidentally was one of the shortest speeches, if not the shortest speech, as far as Finance Minister Nirmala Sitharaman is concerned. But the big takeaway, of course, has been the tinkering in the tax slabs. This is only for the new tax regime, though that is going to become the default tax regime going forward. Aside from that, some other announcements for the green energy space, as well as manufacturing boost, which continues, and capital expenditure also, which has been increased significantly. But we'll discuss a lot of that going forward for the next couple of hours. Right now, joining me on the show is Ajay Bagga, independent market expert. Ajay, thank you so much for joining us. Pleasure to have you on the show. Your first assessment as far as the budget is concerned. The markets, of course, were a bit all over the place, huge moves that we saw after the budget.
Yeah, market impact is because of a particular group and the issues that we are seeing. Overall, it was a very welcome budget. It was prudential. It wasn't populist. The good thing is the quality of the expenditure in terms of the capex being raised to 10 lakh crores, which is like 3.3% of GDP, will be spent on infrastructure in building the next generation of roads, ports, logistics networks, railways, airports, and other infrastructure. So that's a huge boost that has been given. The revenue expenditure was curtailed to about a 3.5% growth over the revised numbers. The subsidies have been reduced over the revised numbers, though if you take them with respect to the budgeted numbers of last year, they are flattish. Focus has been put on railways, on defense, on infrastructure, on green energy, as you mentioned, and on the key segments of women, youth, farmers, the rural economy. So overall, we were expecting a more populist budget, which could have seen fiscal deficit going out of control. There is a 0.5% reduction in the fiscal deficit to 5.9%. The borrowings from the market have been kept flattish. That's again a welcome move. So overall, a very good balancing act with the right concerns and the right targeting of the expenditure on the growth segments as well as on the welfare segments.
Yes, absolutely, Ajay. In fact, if we can also now talk about one of the biggest takeaways, really, which is the change in the tax regime, the tax structure, really, for the new regime. That's going to become default now going forward. What is your first assessment and reaction to this entire move? This, of course, was talked about even before the budget, that this is possibly going to happen.
Yeah, and Avni, if you see, the finance minister has clarified that all taxpayers have the option of staying with the old regime, which allows tax exemptions, or moving to the new regime. What they are trying to do is incentivize the move to the new regime, where you lose exemptions, but you get a higher tax rebate and a lower tax outgo up to certain slabs. So overall, for the middle class, there is a bit of rationalization of taxes. There is an offer that if you move to the new tax regime, up to 7 lakh rupees of income, there is a tax rebate. Up to 3 lakhs, there is no tax payable at all. So, overall, it helps the middle class to make a choice if they would like to move to the new tax regime. The senior citizen savings scheme, the amount has been doubled. The post office scheme, the amount allowed has been doubled. Plus, for women and girls, there is a new scheme available, a 2-year scheme, offering 7.5% and up to a maximum limit of 2 lakh rupees. So there is an effort to provide some relief to the middle class through this tax rationalization, increasing the slab limits at which higher tax rates kick in. So that is welcome. Overall, the tax outgo on due to these measures is about 38,000 crores, as the FM mentioned in her speech. So that's the giveaway to the middle class and mostly to the salaried individuals.
Right. And on that point, Ajay, as far as, this encouraging the new tax regime, and from what I really understood of what the finance minister said, that if you don't choose, you will automatically be moved to the new tax regime. If you want the old regime, you have to specifically choose that. Now, effectively, this means that, a lot of people who were doing forced savings into the tax saving instruments under the old regime will now no longer do that. And my concern may not be a very popular one, perhaps, has been that this is going to reduce the amount of savings that people were otherwise forced to do earlier. How do you view that aspect?
Yeah, to some extent, yes. But Avni, look at a four-member household whose income says 10 lakh rupees per annum, and 10% goes off to your provident fund, and say your take home is something like 9 lakh rupees. So, how much were they actually saving under Section 80C? You think it's practical that somebody earning 10 lakhs per annum with two children, school going children, would have 1.5 lakhs or 50,000 more for NPS? I don't think so. So, if you analyze the data of the 6 crore tax filers, 10 lakh rupees is a very high threshold. Remember, India per capita income is $2,000, and in the rural areas, it is $1,000. So, we are talking of a very limited minority who would have a surplus and who are investing. 4% of household savings are coming into the ELSS or these tax saving instruments. Yes, there will be an impact in terms of the saving class might not be incentivized to into these forced tax savings. That is very much true. But the overall impact on the economy or on the savings rate in the economy, I think that we will need more data and probably see 1 year of experience with this. And again, remember, if you choose the old scheme, you can continue that. But my thinking is it's a matter of maybe 2 years, 3 years, maybe after the next election itself by 2025, they will abolish, because directionally, Avni, the move is remove all exemptions. And today, the revenue secretary said that 60% of corporate tax filings are coming in under the zero exemption scheme.
Right.
So we'll have to get more mature and get used to investing for our retirement and for our financial goals without a tax break. I think that's the big change.
Yes.
Easier said than done. You can't change consumer behavior very easily. It was very convenient that to save tax, especially around the last 15 days of March, people would scramble and put in money to save tax. So it was a very nice way which is being taken away. But I think that's the way it will move in future, and it's inevitable.
Right. A fair point, Ajay. What you're saying is that this is just like a transitionary phase over the next few years, and eventually we will see the new tax regime become the main tax regime going forward as well. The other aspect then is what is your, any thoughts on the way insurance has been treated? Because it's been battered from both sides, really. You've got now the new tax regime becoming the default tax regime, and on top of that, there is the new the tax exemption which has been removed from for maturity amounts on policies which are more than 5 lakh.
Yeah. So again, we would need data on how many such policies are there. What was happening, Avni? I know at least five of my former customers who would just buy peace of mind in the way that I have put in a 10 lakh per month money back policy in my wife's name. And after 15 years, she will start getting 20 lakhs per annum or something like that. So it was used by the very affluent classes. And this 5 lakh premium per annum, if you see, it's not very something that is very widespread. It's a very high premium actually, and not too many Indians would have that limit or would hit that limit. I think the market reaction was overdone, and I think the insurance companies were caught unawares. So we did not get much of spokespersons coming in during the market hours. Let's analyze the data right from LIC downwards to all the private players. Let's analyze the data that how much are is in these kind of schemes. In terms of value, it could be high because HNIs and ultra HNIs were using these schemes. It's an exempt kind of an instrument right now. And what the government is saying, remove even the exemption on the going in, because you will not get the Section 80C benefits in the new scheme. You will be exempt while it is within the insurance wrapper. But on maturity, you end up paying tax again. So it becomes TET instead of EEE. But I would wait for the data. I think it was an overreaction today. And definitely, I think the IRDA will put forward the industry's viewpoint on this. That again, it's a big hit, and if it can be grandfathered, if a couple of years can be given to the industry to bring out other products which can address this, I think that would be that kind of request will be made. But let's see the data. Today, 10-12% cuts in the listed insurers was, I think, unprecedented, and I don't think the hits to their bottom lines are that strong to warrant this. It was just sell now and we'll think later. So we'll
Yes.
get more analysis over the next week, 10 days. We'll be in a better position. But it's inevitable. These things
Right.
will happen. The taxman is closing all loopholes, like the MLDs, for example. Those were sold by to the wealth customers, and under the assumption that it's always a long-term capital gains. And so the taxman has moved in to close
Yes.
loopholes. And
Right.
the big thing is look at your income rather than your tax saving as the big driver, but to have the financial goals as the driver for your investments rather than tax saving.
Yes, absolutely. Ajay, you mentioned MLDs. So I just want to point out, as far as the HNI category are concerned, there are three areas where, things have come into, close that gap that you were talking about. One is, of course, the insurance part of it that we were talking about. Second is capital gains only up to 10 crore used to buy property exempt from the 54F exemption. And thirdly is the market linked debenture, which is now going to be treated not as equity, but as debt. So on one hand, the taxation part of it has come down for the HNIs, but these areas is where the finance minister has carefully closed that, plugged the hole, so to speak.
Yeah, absolutely. And again, people in these segments must realize that they are a very small minority in India. And really, the main thing that the tax department is doing is that they're trying to equalize and tax these segments. Like I end up paying 42.7% tax on my income. Now, I can complain as much as I want, but that's the rule of the land. So if you are
Yes.
fortunate enough to be earning so much, you have to pay that tax. So today, my tax has gone down from 42 to 39 as per the new scheme. But that is if I choose to move to the new scheme. So, that becomes something. So, and there's a fourth also in terms of the REITs. So, the principal return on REITs has become taxable. which was being used by a couple of listed REITs to distribute income to unit holders. So that will make REITs a little unpopular. But overall, directionally, if you look at it, the market is always ahead of the tax department. The tax department eventually catches up. 7, 8, 10 years back, we used to have very nice tax-free bonds. They realized, and which were very popular, they realized that a lot of income revenue for the government was going away in those, and we never saw them coming back after 2013-14. So these, loopholes are getting plugged. Unfortunate if you're an HNI, but you are a minority in a very poor country, and we have to pay these taxes.
Right. Absolutely. Ajay, I would request you to just stay on with us because, like you were also saying, that we haven't heard too many voices from the insurance industry on what's happened today. We've got former director IRDI, Nilesh Sathe, who's joining us here on the show. Mr. Sathe, thank you so much for speaking to us. Ajay Bagga and I were just talking about this, what has come out in the budget for the insurance industry. What can you tell us in terms of the data for this particular segment of policies?
A couple of things. One is, most important is, there is absolutely nothing good for the insurance industry. One, there were a lot of things which could have been amended. Main is on NPS. If you contribute towards pension scheme, you are entitled for tax exemption up to 2,50,000 exclusively. If you contribute towards pension scheme of insurance company, you don't get exemption. Now that should have been rectified, but that has not been corrected. This is one. Second is, under the new tax regime, there is no question of ATC, ATD, or whatever sections under which people used to save money and also get tax relief. Steadily, government wants to push everybody to the new tax regime, whereby probably government wants that you should spend more. Don't think of savings under any section and saving tax in return. So the old tax regime steadily will become not beneficial for anybody. So everybody will move to the new tax regime because that is getting more attractive from income tax perspective, because 5 lakhs has been increased to 7 lakhs only in new tax regime, not in the old. The third very important and that way not good for the insurance sector is if somebody pays a premium of more than 5 lakhs in a year under any number of policies that he has, not necessarily under one policy, then the amount of income that he will generate out of this on maturity will be taxed. It's not clear whether it will be under section 1010D will not be allowed, means entire amount of maturity will be taxed, or the wording is income. Technically, income means whatever maturity proceeds you will get less the amount of premium that you have paid, because it has gone from your own pocket. But in the past, the experience has been quite different. When people used to buy short-term policies, or even now they buy short-term policies, and they are not entitled for section 1010D relief, the entire maturity proceeds are taxed. This is again not correct at all interpretation. But if the government makes the same interpretation here also, then obviously nobody will be interested in putting money exceeding 5 lakhs in insurance. So this is one more disadvantage. And okay, if that is what we want, that insurance should be bought only from insurance perspective and not from savings, fair enough. But then what is the definition of penetration? Penetration is the total premium to GDP ratio. Now, if premium is only going to be the term premium, you just imagine how difficult it is going to be for India to increase penetration. Because if savings are not coming and only term is coming, everybody knows term premium is pretty low. So in that case, it's going to be very difficult for insurance sector to pull on. And the last one, which of course nobody has talked about, is insurance companies are taxed at 14% on their surplus. Now, this 14% has been there since last so many years. And actually, the corporate tax has come down from 70% to almost 25-30% now. So technically, is it not that this 14% should go down to 7% or 8%? But it hasn't happened. So for insurance companies also, they are paying higher rate of tax. So the profitability is coming down. So these are some of the issues which should have been looked at, but unfortunately have not been paid attention to.
Right. So Mr. Sathe, before I go back to Ajay Baga to get his reaction, what you've just said, the way we saw the insurance, listed insurance stocks react today, do you believe that that was sort of overdone, or was it actually warranted given the announcements that came in?
Yeah, it was warranted because all the 3 listed companies have got huge number of clients who are paying premium exceeding 5 lakhs. Although
Right.
Nirmala Sitaraman madam has clarified that it will be applicable for policies which are bought from 1/4/23 onwards, they pay 5 lakhs and above in their policies. So they will have to find client base for smaller sum assured and smaller premium policies, smaller ticket size policies, and that will impact their profitability again. So with this, we expected that these listed companies will get a beating, including LIC for that matter. But then that is precisely what was expected, and it happened.
Right. Ajay Baga, would you like to come in here? This is what, we were just discussing a while back, given what Mr. Sathe has said in terms of the impact on the insurance industry with respect to what's been announced.
Yeah, no, I agree with Nilesh sir totally, and he summarized the issues facing the industry very well. And but again, as I said earlier, people who can afford to put away 5 lakhs per annum are a very small number in the whole country. So when the government is looking at farmers to workers to everybody, our voice is not there. See, as investors in the stock market, we are too small a cohort for any party or any politician to bother much about. When STT was brought in, the capital gains had been abolished. Then slowly it crept back, and finally long-term capital gains was also brought in, and STT was kept on. But again, it's a very small number who actually invest in or who have the surplus to invest in. So every year this representation is made that when STT was brought in, then the then FM had said that because STT you are paying at source every time you transact, I'm removing the capital gains. But then capital gains was again brought back. So same issues are there for the insurance industry. We'll have to grow despite that. So ways will have to be found to structure products like in my wealth banking days, we used to have these star trust set up offshore for clients, which would be whole life policies, and they were rarely whole life policies of 120 years, 125 years. So the event would always happen, and then the distribution would happen to unborn grandchildren, great grandchildren. Trusts would be set up. So we'll move to products like that eventually. Something we'll have to think. So more innovation will have to be brought in. This industry is going to grow only in India.
Right.
We had a more favorable regulatory regime, it would help the industry. They have put in a lot of capital on faith. And for years, they have made losses in building up scale. And still penetration is very low. But again, the balance is, it's a very poor country. So, these are very few people, and we don't get the voice heard most of the time.
Yes, absolutely. Mr. Sathe, what is going to be required now in terms of, will it be just sort of tweaking of strategies as far as the insurance companies are concerned, or will it require complete overhaul of strategies and ways to get consumers and ways to increase penetration? Because that's one thing that the industry has struggled with for a long time, and even now is still extremely low.
Yeah, penetration has been going up, though low, but then it's going up because insurance companies have been marketing savings-oriented policies. Abroad, it is only the term insurance which is brought. So obviously the premium is pretty low. And despite that, the penetration in India is low. That means it's a serious thing to be thought about. One thing which Ajayji rightly said is they will have to rework out on strategies as to which products should be sold in this tax regime. And absolutely right, whole life policies will be sold more because it has been clarified that on maturity, although it will be taxed, on death it will not be taxed. So the amount that the nominees will get in case of death claim, even if the premium is exceeding 5 lakhs, it will not be taxed. So obviously, insurance companies will have to rethink on which products they should market. But the shin towards endowment plans, money back policies, and alike will definitely go down because nobody wants to get money only after death. So this is something which in India, especially the psyche is such: what is it that I'm going to get when I'm alive? And if the answer is nothing, then he goes a step backwards. But yes, it's going to be a challenging time for insurance companies because of these provisions which have been made in the budget, announcements which have been made in the budget. But still, they will cope up with that. But the regime is going to be challenging, no doubt about it, going forward.
Right, absolutely, Mr. Sathe. Thank you so much. And Ajay, thank you so much for joining us with your perspectives and your views as far as this budget is concerned. Let me also now welcome our next guest who's joining us. We've got Trideep Bhattacharya, CIO Equities at Edelweiss AMC. Thank you, Trideep, very much for joining us on Editorji and speaking to us just hours after the budget announcement. What was your first reaction to this budget?
Hello, good evening. Thanks for inviting me to your show. I actually went through the first announcement. My first reaction was that it looked like to me a Panchamrit budget with, and if I were to summarize it in one sentence, it will be growth at reasonable fiscal prudence. The worry going into the budget was that since this is the last full budget ahead of elections, that if the government turns populist and gives the fiscal consolidation target or aim in mind, that might be bad for currency and how the world views the budget overall. But what we saw is a well-balanced budget from a growth standpoint, but at the same time, the fiscal targets being maintained at 5.9% for FY24 gives me the sense that that fiscal consolidation, fiscal prudence kind of mindset has not been lost. And hence, from that perspective, I would call it at growth at reasonable fiscal prudence.
All right. And in terms of course, the big question now is, which tax regime to opt for. This is something, the new tax regime getting this kind of an encouragement and incentive really for people is something that was talked about even before the budget. But now with this, what is your advice as far as investors are concerned, as far as the salaried class is concerned?
So I think the first thing that we need to appreciate, acknowledge, and note is that rather than increasing the tax rate, the government is looking to increase the tax base, which is a good way to increase the tax revenues from a medium to long-term perspective. And keeping that in mind, reducing the administrative hassle overall with regards to various exemptions, this, that, the other, the new regime is always is all the more kind of little less an administrative hassle, and by giving incentive for people to sort of on the new regime to capitalize on lower tax rate, I think what the government is subtly indicating to the public at large is to move on to the new regime, which is simpler, hassle-free, and as it looks like from a tax arbitrage, from a tax benefit point of view, a better tax regime to be in, as opposed to claiming multiple benefits and whatnot. That is, of course, subject to individuals' circumstances, which can always be different. But I'm talking at a very macro level, what the government is looking to achieve. I think increasing the tax base by making it hassle-free is a step in the right direction.
Right. And what is your view? I just had a detailed discussion with my previous guests as well, as far as the insurance sector is concerned, and the way we saw the stocks reacting today as well.
I think, again, I generally tend to go with what is the government trying to achieve or signal. And I would say that from that perspective, directionally, what the government is trying to do is reduce the moral hazard where some of these products were missold because of there was a tax arbitrage or tax benefit, while the intention of the investment could be something else. I think by rationalizing the tax regime across multiple products, that's what they are trying to do. Now, obviously, from a near-term standpoint, it reduces the attractiveness of some of the insurance product at the expense of others, and some of the insurance products at the expense of other products altogether. And I think the water will find its own level as this gets rolled out. But I think in the way that the government is looking to achieve what it is looking to achieve from a product standpoint, I think that the direction is positive. What it also shows is that there's not been any flip-flop with regards to any measures being taken in earlier budgets and rolled back this year or stuff like that. That the directional continuation of reforms, whether it is from rationalizing tax arbitrage, or for that matter, kind of making hassle-free income taxes, I think is structurally positive in the way government is thinking about finances.
Right. In terms of, long-term capital gains, there was a big worry that something negative might be announced that could hamper investor sentiment, but sigh of relief that nothing on that front was announced?
Absolutely. I think there are two things clearly. One is that given some of the recent issues that have come to the market, particularly some of the money raisings that have come about, the market on the back of such an event entered with a bit of nervousness into the budget, thinking about that if there is any negative on the capital gains tax, or for that matter any measure that is counterproductive from an equity market standpoint, the markets could take a dim view of that. Fortunately, the finance minister steered clear of that and navigated through the measures, particularly with respect to financial sector, rather cleanly.
Okay. In terms of ease of doing business and a couple of other areas, for example, KYC, and that PAN will be the common business identifier, DigiLocker as well, one-step solution for reconciling identity. These are small things that were announced, but in the larger picture, larger scheme of things of the government's push towards trying to make things easier, while that wasn't really done for long-term capital gains and the mess that is in terms of the different asset classes. On this front, this is going to help investors to sort of ease things up a bit.
Absolutely. I mean, I think that's what I mentioned earlier, that the government's intention to make it more hassle-free, more governance and less government, the way it is kind of going about streamlining various different administrative stuff is worth commendable. And I think, again, what's worth commendable is that there is a constant effort in the same direction. There is no flip-flop. There is no change. Earlier budgets, we used to have some measure, then roll back, and all of those things used to create a lot of confusion amongst people. This time, the direction is clear that we are moving towards less administrative hassle-related solutions. We are moving towards increasing the tax base rather than tax rate, and procedural hurdles will be removed. With that being there, that being an enabler, I think the government's focus on infrastructure growth, the capital creation part of the economy, and stuff like that gives overall a direction to the economy, which makes the bottom-up driver for the Indian economic progress fairly robust, actually, particularly on the back of slowing global demand.
Right. And Sudeep, I have to ask you now, because this is again a question that would come a lot at this point in time, in terms of what should an investor strategy be, one's portfolio, given the kind of volatility that we've seen over the last few days, and even today, in fact, as a result of the Adani stocks.
So I would be a little careful about mentioning any particular stock name or a group name. But I think let me set the context.
I'm talking about a retail investor's investment strategy at this point in time, because obviously the fears are of how do you deal with such volatility.
Correct. So I was going to first set a bit of a context that, this year, the theme that we have been talking about for our distributor base, our investor base, and through your show to your investors as well, that, this is a year where we'll probably face recessionary conditions before rebound. Yes. If I were to summarize in one sentence. That is not to scare people, but basically just to understand and have a gradual understanding that over the last 6 months of 2022, we have seen 400 to 500 basis point increase in cost of capital globally, not just in India, but globally. That will impact the economy's growth rates over at least the next 6 months, if not longer. And I think the first 6 months of this year, we will have to see that through before we start seeing rebound in the various global economies, including India. With that context, or in that context, I would surmise that hence the first half of the year is going to be rather volatile. And in that volatility, should one stay away or should one invest? In my opinion, this is where the medium-term outlook needs to be kept in mind, where from a medium-term standpoint in India, it is fairly constructive. And it's constructive because of 2 or 3 reasons. First, I think for the first time, we are seeing a good amount of capex cycle, incipient signs of the same coming through. We saw the budget today showed the government intention to continue with the same. And I think this will get stronger, particularly as we get towards the back half of this year, leading on to elections next year. Second, I think the budget talked about it, but even before that, we've seen a good amount of housing recovery, which makes the economic recovery generally broad-based, and it's a very bottom-up driver specific to India. Given some of the socks that the government has given, it is likely to be in the positive direction. And third, some of the government-specific themes like PLI, manufacturing related benefits, etc., are going to hold the Indian manufacturing sector in good shape. So net-net, the bottom-up themes for India for the next 2 to 3 years look fairly strong. So my advice, as you said, that how should retail investors think about markets? I would say that expect the first half of this year to be volatile, given that globally we will be facing recessionary conditions. Use that volatility to gradually increase exposure to equity markets, not in one shot, but gradually over a period of time, so that one can capitalize on the drivers that we talked about from a medium-term perspective through their portfolios. A long-winded answer, but hopefully.
Yes, absolutely. That's what I was looking for, in fact. But Trindeep, from a more macro perspective, that you were also talking about possibility of a global recession. The economic survey, of course, was very optimistic. There seems to be a lot of optimism on how well cushioned India is in this kind of a scenario. But without sounding like the dampener, what are the downside risks? How bolstered are we really?
So I think there are 2 aspects which we have to be careful about. When we talk about economy, there is economy and there are markets. They are not divergent, but markets tend to sort of preempt what is there in the economy. So what we've seen pick up from the COVID related issues, the pent-up demand, all of these things, the rate increases and the follow-through with regards to lower growth rates are actually captured in the number that you just quoted in the economic survey, if you look at first half versus second half. So I think that is baking in some amount of slowdown already. But when the numbers comes in front of us, that is when we realize that, the growth rates have slowed down from 6 or 7% to 4.5%. And I'm talking about those kind of numbers. So on the face of it, the valuations that India has been quoting at, particularly in the beginning of this year, is on the higher side. So a lot of some of the positives sometimes get factored in too soon. The second downside risk could be that as some of the group-related issues that you talked about, which is recently kind of cropped up, have the potential to deflate the P multiple of Indian markets from a perception standpoint in the very short term. So we have to be mindful of that. On net balance, what I'm saying is that I think while our earnings growth resilience is fairly there, as you pointed out, the PE multiple seems to be a little bit on the higher side, particularly when you compare relative to other markets. I think that is where we are likely to see probably a bit of compression. We are already seeing some. We might see a bit of compression in the first half of this year, before which it normalizes and takes its normal course.
All right, Pradeep, we'll leave it there. Thank you so much for joining us and giving us your perspective and also your advice for investors who are wondering how to tackle this volatility. On that note, let me also bring in our next guest who's joining us, Dr. Shubda Rao, founder Quantico Research. Dr. Rao, thank you so much for speaking to us on Editorji. Your first takeaway from the budget before we get to the specifics. What was your reaction?
Thank you, Avni, for having me on the show. I think the first take would be a very responsible, conservative, and growth-oriented budget. Gives equal thrust on reviving consumption and revving up further the capital investment cycle through the government's budget. So overall, I think growth impulses have been equally focused on both from the consumer side as well as the investor side from CAPEX side. And while maintaining that, important was it does not get prolific in its spending. So fiscally responsible budget is what I would like to call it. We can get into the specifics, but I think a very well balanced and a well focused budget, I would call it.
Right. On the fiscal front, the finance minister very clearly said that there is no question about maintaining the fiscal trajectory going ahead as well. Any risks to that, do you think?
I think it's going to be very important to, double down the effort on the asset monetization program, continuing its intent of completing disinvestment. While we do acknowledge that tax growth projections have been kept realistic, but let's not forget, unlike this current fiscal year where we had a cushion of a higher nominal GDP compared to what was budgeted for, it gave a little bit of a fiscal headroom to exceed on expenditure. Unlike this current year, the fiscal 24 is not going to have an equal headroom on nominal GDP. A 10.5% growth will likely remain a 10.5% growth in nominal terms. So the government will have to entirely ensure that it walks the talk on the revenue side, greater tax coverage, tax compliance, managing expenditure well on course, and of course, doubling its effort on the asset monetization programs and disinvestment, as I said. So the risks, I wouldn't say that there is a probability of all of them materializing, but the government will have to continuously monitor these developments every quarter and take stock of how well they are performing on the trajectory of not just maintaining the 5.9% fiscal deficit ratio for fiscal 24, but as has been indicated by the finance minister herself, that by fiscal 26, they would want to get to below 4.5. It is a fairly, I would say, challenging task, but it's not impossible.
And I'm glad you mentioned the disinvestment aspect and reminded me, because that's been one issue where last few years, it's always been some issue or the other where the disinvestment target has not been met. And given that the coming year is also, we could see some amount of volatility going ahead, possibility of a global recession as well. Once again, the disinvestment aspect would possibly need another overhaul of strategy to ensure that it goes through.
Very well pointed out, Avni. I think disinvestment, not just last few years, I think last few decades has not been exactly meeting the targets, Market conditions, of course, play a large role. But importantly, I think if the government identifies just 3 or 4 important public sector entities and identifies them for strategic sales, I don't think it's a difficult task to meet a 51,000 crore disinvestment target that the budget has put forth for fiscal 24. The idea is to plan ahead, to prepare well ahead. In the ongoing fiscal year, we did have some benefit because LIC disinvestment did get pushed into the current fiscal year. But in the coming year, we will have a fresh about 4 or 5 entities that the government has identified, and they would want to push it ahead right from Q1 onwards. So we, like everyone else, will be keeping tab on how the government progresses on the disinvestment path. As I said earlier to your question, Avni, that there is going to be very limited headroom for extending expenditure or underachieving revenues.
Right. Absolutely, Dr. Rao. Let's talk about now the other big point that you also talked about was the capital investment outlay, which is 3.3% of GDP, and effective capex is 4.5% of GDP. This is, of course, a very strong number. But how much do you think this is going to contribute or at least help in spurring the private investment cycle? Because that is one area which even the economic survey then mentioned that it's required to create jobs. And that's really not been where it should be at this point.
No, I think it's a fair point that, we always look for government propelling, like in a Keynesian world, crowding in investment, if I may use the word. And the government over the last 3 years has been pumping in the capex. I would say this is unheard of, that last 4 years average of capex growth year on year has been close to 32%. I think it's a historic high. The government has more or less achieved in the past what perhaps really did not materialize for the government was the crowding in of private investment, which your question alludes to. And private investment perhaps was waiting in the wings, predominantly because of what the last 2 or 3 years have ensued in terms of COVID pandemic and the war and the ensuing global uncertainty. We believe that as we move into the coming year, all the enablers are in place. The corporate tax remains low, capacity utilization remains high. You have cleaner balance sheets on corporate side and on the banking sector side. A slight improvement in the risk appetite from the private sector is expected in the coming quarters. We believe that globally also, perhaps most of the central banks would be fairly close to the peak rate hiking cycle, and that would bring in some stability in terms of the monetary and financial conditions of the advanced central banks, which probably will bring in corroborately some stability in the perception of which are the economies which are poised to grow far better than the rest of the world, and India would obviously stand out on that platform. So one expects, with capacity utilization levels having improved significantly over the last 1 year, private capex should also start coming in. You have simultaneously a thrust on railways, big employment source. You have thrust through PPP as well on tourism in the budget, which is also employment intensive. So I think there have been sectors which have been given impetus, which have employment intensity. So one expects that capex typically would have a larger impact on the overall economic activity and the GDP. We normally expect a 5x in the near term impact of capital expenditure on the GDP. And if you expand the horizon by about 7 years, compared to the revenue expenditure, capital expenditure can actually bring in 7x kind of impact on the GDP. So what early days yet, but I would think there would be global macroeconomy stabilizing would be a positive factor for the private sector to look at going forward. Yes, there are recessionary or softer growth conditions panning out, but I think China becomes one example where there's some revival expected.
Yes, yes, absolutely. Dr. Rao, a thought on, the Manrega allocation, which is the lowest in 4 years this time around. Of course, there's been some talk surrounding that. You can't compare it to the pandemic because that is when it was significantly increased at that point in time. But nonetheless, given the current scenario, what is your sense of this kind of an allocation?
I would think Manrega is more or less should be looked at and perceived as a work in progress through the year. Now, let's not forget, last year, Manrega allocation was maybe 70,000 crores, but the revised estimates seem to suggest that it exceeded by at least 10 to 12,000 crores in effect. So I think need-based, the government will have room to adjust some of the Manrega allocations as the year goes by. As I said, the capex thrust has been on railways, highways, some bit of defense, and of course the states. Now, if the capex is actually, executed as per planned and as per budgeted, we should be able to see lower need of extending employment from the government side through Manrega. But of course, this year we do see a lot of normalcy returning post the pandemic, last 2 or 2.5 years. So I think this would be the first full fiscal year as being the most normal year, and that would help government execute its plans far better, in my opinion.
Right. Now, looking at the global scenario, of course, like I was pointing out earlier as well, the economic survey is very optimistic, the budget as well, in terms of India's position and how it is possibly bolstered from any kind of a global recession that we may see. Continues to be the fastest growing economy going forward as well. But your sense on how bolstered are we really, how protected are we when it comes to that kind of a global recession in the other economies?
I think that's a great question, Avni, because while definitely the government, and yesterday the CEA also said the base case scenario for economic growth is 6.5%. At this current juncture, we are looking at a slightly lower growth estimate for GDP in the incoming fiscal year, that is 24, at about 6%. Of course, we may need to fine tune post the budget, fine print reading. But as of now, even if we are at 6% and compared to what we were in the fiscal 23, our assumption is we would have grown by 6.8%. Now, the 80 basis point, we see the correction of which 50 basis points coming through the global recession and softer global demand conditions. So it's not that the government is also, completely out of sync, recognizing and acknowledging that global support for domestic growth is unlikely to be very meaningful. But on the other side, the government has given enough impetus, in our opinion, at least today is what we believe from today's readings, the first cut readings, is I think there is enough impetus on supply side. There is adequate impetus on the demand side, that is on the consumer side. So if we actually look of these getting executed well, walking the talk, then probably we could look at a growth somewhere between 6.5, and that is not too bad when IMF has put its global growth forecast at 2.9% for calendar year 2023. I think a lot of focus should be on the execution. The PLIs are already underway. They have begun to do well, particularly if you look at electronics exports, and likewise the ongoing fiscal year and the next fiscal year, we should see greater execution through PLIs, giving impetus to whatever export potential that India can have with the rest of the world.
Right. Dr. Rao, you spoke about the impetus to demand and consumption that, of course, we've seen today as well with the focus on the new tax regime and the tinkering that was done with that at this point in time. But India has always been a country of, high savings. Given this is clearly a move to put money in the hands of the consumer at this point in time, whereas the old tax regime used to force savings. That might not happen with the new tax regime. How do you see this balance playing out from the larger perspective, from an economic perspective?
Yeah, I think we need to look at how the personal disposable incomes of the common individuals are going to get impacted because of the budget measures. Yes, there have been steps taken for the middle income, middle class, as we call it, or senior citizens, or greater, for the peak taxation rate has been brought down, say, from 42% effective to 39% effective. In hand, people will have slightly better incomes. And as you rightly said, the income, your disposable incomes have to be divided between consumption and savings. I would say that, the pent-up demand is somewhat being seen waning. The way we have seen pent-up demand supporting significantly the growth outcomes in fiscal 23, that pent-up demand post-pandemic is seen somewhat weakening. But at the same time, what we also need to look at is how well the role of inflation is going to play in terms of the appetite to consume and appetite to save. Now, let's not forget, we are coming with a year of somewhere close to 6.7 average consumer inflation. And in the coming year, most of economists, including us, we are, forecasting consumer inflation to come down by over 120 basis points. Our own estimate is close to 5.3%. That itself, in my opinion, becomes an impetus to consumption, because the real purchasing power gets impacted by how much you have it in real terms. And if inflation is lowered, and that is to some extent, I think, also going to be an outcome of what the budget does on supply side of economics. So all in all, yes, we may see some pruning of some of the excessive expenditure consumption items, but the consumption is going to get better distributed and not just get restricted to very high net worth individuals. It's going to percolate down to middle income group and to the lower income groups, in my opinion, and that is more durable. That, in my opinion, is slightly more sustainable.
Absolutely, Dr. Rao. Thank you so much for joining us with your perspective on the budget and the macro perspective as well on Editorji at this point in time. That was Dr. Shubhda Rao giving us her take on the budget and what could emerge as potential risks, what are the bright spots as far as the economy is concerned. We will have more guests coming in on the show, but for now, let's listen in to what the finance minister said earlier.
Those with income up to 5 lakh do not pay any tax, do not pay any income tax in both old and new regimes. I propose to increase the rebate limit to 7 lakhs in the... I propose to increase the rebate limit to 7 lakh in the new tax regime. Thus, persons in the new tax regime with income up to 7 lakhs will not have to pay any tax at all. The second proposal relates to middle class individuals. I had introduced in the year 2020 the new personal income tax regime with 6 income slabs starting from 2.5 lakh. I propose to change the tax structure in this regime by reducing the number of slabs to 5 and increasing the tax exemption limit to 3 lakhs. The new tax rates are 0 to 3 lakh, nil. 3 to 6 lakhs, 5%. 6 to 9 lakhs, 10%. 9 to 12 lakh, 15%. 12 to 15 lakhs, 20%. And above 15 lakhs, 30%. This will provide major relief to all taxpayers in the new regime. Now I come, Honorable Speaker, sir, the capital investment outlay is being increased steeply for the 3rd year in a row by 33% to 10 lakh crores, which would be which would be 3.3% of GDP. This will almost be 3 times the outlay made in 2019-20.
Well, those were some of the points that the finance minister talked about during the budget speech earlier today. I just want to take you through some of the other announcements that came in as far as the small savings schemes are concerned. There was a new small savings scheme which was announced called the Mahila Samman Savings Certificate. Essentially, this is a new savings scheme for a period of 2 years, limited time for this scheme, where it can be opened in the name of women or girls. This is available for 2 years until March 2025. It's a deposit facility of up to 2 lakh rupees, a tenure of 2 years and a rate of 7.5%. It has a partial withdrawal option as well. The other announcement comes in as good news for senior citizens, because senior citizen savings schemes, the maximum deposit limit has been hiked here. It has been hiked from 15 to 20 lakh rupees. So that's a significant boost for this particular scheme and the exemptions available under it. Also, the monthly income account scheme, there also the maximum deposit limit has been hiked. It is, the single account was hiked from 4.5 lakh to 9 lakh rupees, whereas the joint account has been hiked from 9 lakh to 15 lakh rupees. So those are some important schemes that were announced as far as the small savings schemes are concerned. But of course, it was negative news for the insurance sector, where policies above 5 lakh sum assured are going out of the 1010D exemption. So income from policies where premium paid is essentially more than 5 lakh rupees, that is now going to be taxed. So this is negative as far as the insurance companies are concerned. But other announcements were made to simplify the tax, the processes as far as KYC is concerned, income tax returns are concerned. The average processing time for ITR was reduced from 93 days to 16 days. So that's a significant reduction on that front. And the KYC process itself will be simplified further. It will be fully digital, and there will be one-stop address processing that will take place. Remember, this KYC simplification is something that the RBI also put out certain regulations and rules for to make the process simpler and easier for consumers and for customers of banks. So you no longer have to visit a bank in any case to get your KYC updated. You can do it from home as well, and banks have to make that provision. So this is another aspect that was talked about in the budget. Now, the conversion of physical gold into digital gold, that will not attract any capital gains tax. So this is another important point that has come in from the budget at this point in time. So these are some important points that were mentioned. And of course, the new tax regime that was given tweaks and made more attractive for taxpayers. It is now going to be the default tax regime. Now, what does that mean? That means that henceforth, you will not need to choose the new tax regime. Automatically, the new tax regime will be applied. If you want to choose the old tax regime, then that is what you need to do. So that is going to be the process that will be followed. So you still have the option to choose the old tax regime if you want to avail of the other benefits under that, including ATC, ATD. All of that is not available, of course, in the new tax regime. There's a no income tax for up to 7 lakh rupees under the new regime. The rebate has been increased from 5 to 7 lakhs. The highest surcharge has been cut from 37% to 25%. Again, only in the new regime. So this is the maximum tax rate comes down to effectively to 39% from 42.7%. And so if you have opted for the old tax regime, then this will not be applicable to you. So all of this in an effort to make the new tax regime more attractive. What experts say that this is a transition period, and eventually it will only be the new tax regime that will be in place. But on that note, we'll listen in to some of the other important announcements that were made by the Finance Minister.
Waiting for personal income tax. I have 5 major announcements to make in this regard. Currently, those with income up to 5 lakh do not pay any tax, do not pay any income tax in both old and new regimes. I propose to increase the rebate limit to 7 lakhs in the I propose to increase the rebate limit to 7 lakh in the new tax regime. Thus, persons in the new tax regime with income up to 7 lakhs will not have to pay any tax at all. The second proposal relates to middle class individuals. I had introduced in the year 2020 the new personal income tax regime with 6 income slabs starting from 2.5 lakh. I propose to change the tax structure in this regime by reducing the number of slabs to 5 and increasing the tax exemption limit to 3 lakhs. The new tax rates are 0 to 3 lakh, nil. 3 to 6 lakhs, 5%. 6 to 9 lakhs, 10%. 9 to 12 lakh, 15%. 12 to 15 lakhs, 20%. And above 15 lakhs, 30%. This will provide major relief to all taxpayers.
All right, that was the finance minister. Some important announcements from the budget speech earlier today. But let me welcome our next guest. Mr. Niranjan Hiranandani is joining us here on the broadcast, MD Hiranandani Group and National Vice Chairman of NAREDCO as well. Thank you very much, sir, for speaking to us here on Editorji. What was your first takeaway from the budget, one of the shortest budget speeches possibly?
Avni, I think the budget was very balanced. Looking at the fact that our adjoining countries like Pakistan, Sri Lanka are in difficulty, Russia-Ukraine war is still on. Many of the Western countries are in recession and have huge unemployment rates. I think it was a fantastic budget of growth, 6.2, 7.2% targeted in terms of growth. 10 lakh crores for the purposes of capital investments into infrastructure, 30% growth. I think that was really a statement which was out of the box. I think that's unbelievable and beautiful, because I think that is really going to make a difference to the entire economy. The fact that our direct and indirect collections have also moving up this year, 2022-23 and 23-24 expected also to increase further. I think all in all, if you look at it, the budget has really covered all aspects of the economy and is stated to move upwards. It's targeted to move in a in a positive direction. Of course, there have been certain things which are required to be done for the electorate. For instance, the increase from 3 lakhs to 5 lakhs, 5 lakhs to 7 lakhs. I think that was really a good thing, though, of course, it doesn't allow you the benefits of tax deduction. But I think overall, the budget was very balanced, very good. And also looking at the growth in the future to reach the target of the Prime Minister of $5 trillion economy. So very balanced budget, I think, this time. And being able to take the situation also took into consideration that deficit financing will remain under control. I was a little doubtful that they will be able to do it and reduce the point and still keep to the idea of restricting themselves on deficit financing. So that's a good budget.
Yes, absolutely, Mr. Hiranandani. That seems to be the view across the board, that it was a very balanced budget that looked at all aspects as well. But, just want to ask you on the real estate sector, of course, there were a lot of demands and expectations. None of that really came through. What would be your reaction to where the sector is now, what it requires? And of course, unfortunately, nothing did come through in the budget.
Avni, dil mange more. And I agree with you. We are not fully happy with the kind of things. Our demands were much more. But let's look at it from another point of view. We have been able to get 69,000 crores of rupees for the purposes of the PMAY scheme. Now, that is something which is, 79,000 crores. I'm correct myself.
Yes, 79,000.
PM Awas Yojana. And I think that will meet the target of 1.1 crore houses to be completed in the last 5 years. So I think that's a very positive on the affordable housing story. However, that will have to continue in the next couple of years. Remember that even the richest city in India, Mumbai, has still got 50% of the people living in jhopatpattis and slums. So we have a long way before we will be able to complete the target of affordable housing, especially in the cases of the slums and other areas that we are talking about. So that's an aspect of it which I think still needs to be countered, but it's a good thing that a commitment of this sort has been given. City infrastructure, especially tier 2, tier 3 cities are also included this time. And as you are aware, MMRDA region, we have got a huge amount of infrastructure being developed in terms of metro. 330 kilometers of metro are going to be completed in the next 2 years in Mumbai region. The Cross Harbour Bridge, which will be 22 kilometers across the sea, and will open up a huge land on the mainland. And Mumbai will no more be called an island because it will be fully connected to the mainland now. And also the coastal road and other aspects of it. So I think all in all, if you are seeing development, real estate, infrastructure, multiplier effect of infrastructure and real estate development, which will help employment, which will help 260 industries like steel, cement, paints, tiles, copper, wiring, plumbing, you name it, and 260 industries are covered. And most important of all, the multiplier effect of investment in infrastructure and housing is going to actually improve the employment potential. It's one story to talk about GDP growth. It's another story to say that employment will be increased. I think if you marry the two, which is growth of GDP with employment, then you're going to see a different country completely. And I think that is something which focus on, including tourism. Tourism will also be a very big focus. Yes. And that's also a very labor-intensive activity like real estate, housing, and in manufacturing, textiles.
Right. And you mentioned a very important point about employment, because jobs, I believe, is still one of the biggest challenges that is facing this economy. And real estate sector is a sector where there is a lot of job creation that goes on. On that front, how do you see, the job scenario panning out going forward?
Avni, you've hit the nail on the head. The secret is that 5 years ago, when I wanted 100 skilled people, I would get 500. Today, when I want 100 skilled people, I don't get 20. If I want a carpenter, a plumber, an electrician, a painter, a fitter, a marble layer, I don't get them. And on the other hand, most of them are unemployed. So people who are unskilled are unemployed. And we have an unemployment problem, Avni. On the other hand, when I want labor, we are not. So one of the targets which the finance minister has mentioned, she's talked about skilling and reskilling and upskilling, which is very, very, very important. Because what happens is there's no point in creating jobs and not having people ready for it. Look at the other one, which is a wonderful statement. Where I heard about the nursing colleges. You know, during this pandemic, we had doctors but couldn't have enough nurses. Can you imagine, in a country like India, which exports nurses, we don't have enough nurses for India. So they're going to put up 175 nursing colleges immediately. But you also need to put up 200 medical colleges because of that. But nevertheless, at least one direction they are doing. So the skilling part of the story becomes equally important as investing into housing or infrastructure.
Yes, absolutely, Mr. Hiranandani. I completely agree with you on that front. The other aspect here, when we look at the real estate sector, you've got inflation. You've got rising interest rates. Inflation, of course, now, we are being told it's not a worry any longer. The rising interest rates as well. And the fact that there has been nothing for the real estate sector, like we just spoke about, that's coming from the budget. How do you see demand going forward? Because last year, of course, was very strong, especially on the residential sales front. But going forward with this scenario, do you think demand could get hit?
Avni, let's look at it this way. Last year, interest rates did go up. In spite of that, real estate sales increased by 15 to 20%. In fact, the higher end of the the pyramid in terms of expensive houses had a bigger increase in number of sales as an incremental value than the affordable segment, which is the first time in my whole career. So what I did see is that people are willing to spend on a house after this COVID story, that they want a better house. They need a house which will accommodate husband, wife, and the children. And during COVID times, they had to stay and be in the house. So they don't mind, if they can afford it, to make a bigger house for themselves, if they can afford it, of course. So the situation in the entire story is that the way forward that we really need to do is to see that this segment is again given a bigger boost in this budget, in the today and in future. If you want India to grow to the $5 trillion economy quickly, and if you want GDP growth to be even double digit ultimately to happen, it is only real estate and infrastructure, and these are the segments which pushed China to a double-digit GDP growth much faster. Now that they have finished their infrastructure, now that they are not making houses enough because there are too many houses already in the economy. Economy growth in China is gone down, though they're still, the size of the economy is still 6 times India. So we'll take a long time to catch up. But in fact, the growth pace has come down simply because these aspects are not covered. So if you look at the other aspect of it, the focus that we really need to do in terms of real estate and infrastructure is much more. If you want GDP growth, if you want per capita GDP growth to happen, it has happened. You will have to focus on these segments, and of course, things like textiles also.
Right. One more point, Mr. Hiranandani, that was announced in the budget that I want you to help us understand what kind of an impact could possibly have. But before that, just for our viewers to explain, capital gains only up to 10 crore used to buy property will be exempt from tax under Section 54F. This essentially means that if you've made capital gains, say, for example, of 15 crore, you use that 15 crore to buy a residential property. Earlier, the entire amount was exempt from tax. Now that will be only 10 crore that will be exempt from tax. You will have to pay tax on the balance 5 crore. So this is a change that has come in the budget today. But Mr. Hiranandani, what is the kind of impact you think? Of course, the government has used this to sort of, plug the gap, as somebody was saying earlier. But what is your perspective?
Well, it's a negative proposal, which I'm not happy about. See, people used to sell one house, Avni, and buy 2 houses for 2 children, 2 brothers, brother, sister. And they took advantage of that and did it. And because the prices of their old house has gone up, historically, that house may have cost 25 lakhs or 50 lakhs, and today it's worth 12 crores or 14 crores, and you've sold it. And you want to buy 2 houses or apartments in the suburbs or other places for 2 of the brothers, sisters, or whatever it is. And the benefit was available there. So I think it was for a residential house, and I don't see any good reason why it should have been withdrawn. Maybe some persons misused or abused that thing. For one reason, the country should not suffer. I think this should be brought back, and we are going to represent that this is not a good idea to do it. The other thing, Avni, which I'm very happy about, is that, and we had demanded it, was that the maximum rate of tax for individuals should be brought down.
Yes.
India has the highest individual rate of tax, which was 42% for an individual. For partnership, it is 35. For limited company, it's 25. And for new manufacturing companies, it's 15. I didn't understand why the maximum rate for an individual should be 42%. We've been demanding it should be reduced. They brought it down to 39. I'm hopeful that next year they will bring it equivalent to a partnership, which is 35, but it's a step in the right direction.
Yes, absolutely. And your view on the entire, transition to the new tax regime at this point in time, because obviously that has none of the exemptions under any of the sections, ATC, ATD, all of that. So effectively, a lot of it was forced savings, which will now no longer happen.
Yeah, this is a trend which the government has started 2 years ago, 3 years ago. And they were very clear that they wanted to remove the exemptions and bring about a lower rate of tax ultimately. And they did it in the case of corporates, where they brought it down to 25% and then 15%. I think similarly, if they can reduce these tax rates to much lower rates than done, which they have done by giving exemptions, this was the purpose which has been stated by Nirmala ji 2 years, 3 years ago in the budget also. And she is actually keeping up her commitment, which she did. The result has been the fact that those people who don't take advantages of other benefits would get a 7 lakhs of rupees tax-free. And that is a good thing to happen, because 50-60% of the people do not take advantage of all the schemes. So that is a plus point to do. But I do agree that some people would not benefit from this, but you have an option. So nothing wrong with an option which is available to a person. You can choose one scheme or the other. And I think ultimately they will make it so that people will gravitate to the new scheme ultimately. And that is the wish of the finance minister and the government. And I think they will do it in a couple of years, which will happen automatically. So, but it's a good thing. If overall the rates do come down and keep coming down, collections are going up any which way, in spite of the fact that the rates are coming down. And if they continue to do so, both in terms of it, I think it'll be good, because GST collection has gone up. It's an all-time high. Collections of direct taxes have gone up all-time high. And if they continue to reduce rates, I'm sure the collections will go up, which is the normal trend to happen, that if you have a high rate of tax, the collections actually come down because people tend to avoid those taxes.
Yes, absolutely. Mr. Hiranandani, the other aspect from again, something that you mentioned earlier, the effective capex, 4.5% of GDP, that number coming in, which of course a lot of people are extremely happy about in terms of the budget. But the other aspect is the private, investment, which is yet to pick up. And that is something that even the economic survey mentioned, that is essential for creating jobs as well. When do you think, or what really do you think needs to happen? Do you think this kind of a government capex will spur private investments?
I think one does not have anything to do with the other, and at the same time, it has everything to do with the other. Yes. So let's look at the fact of infrastructure investments which is taking place, which we are talking about: roads, railways, waterways, airports, multimodal transports, and others. Today, the logistic cost in India is 13% of the value of the product that you buy. 13%. In China, it is 7%. So there is a 6% delta. Everything that you buy, or I buy, or an industry buys, has a logistic cost on an average of 13%. If that is brought down to 7% by doing all this, we will save a cost of 6% on every item that you buy, and we will become internationally competitive when we sell goods and export to abroad, when we sell it in export goods. So the question is, whatever the government is investing into logistics and infrastructure will actually spur GDP also separately by another 2.5% over a period of years. So your travel time, your cost of travel, your cost of transport of goods, whether you're buying a toothpaste or you're buying steel or you're buying a product or you're buying anything even through e-commerce, the cost of logistics, if it comes down, is a big saving for the country. And this is why infrastructure development will do it. It has nothing to do the other. In fact, the whole country developed. Government infrastructure is essential, irrespective. Number two, when you make things, logistics costs come down, it spurs industry to invest more in various locations in the country. Because earlier you would have trouble transporting the goods, either getting raw materials or finished goods. So it will automatically, you don't have to push private sector. They will definitely grow into the manufacturing and goods and production areas. And that is why you see industrial warehousing and other aspects of it also growing in India, and also FDI coming into warehousing and industrial. Even our company has set up a joint venture with Blackstone for the purposes of doing this. So all in all, I see that the government investment helps the country tremendously and will spur the private sector to do so automatically without asking them to do so.
Right. Any concerns or worries in terms of downside risks if we look at, the global scenario, the possible recession, and of course the inflationary scenario here as well?
In life, when you have a big target, Avni, there can always be pitfalls. COVID was one big pitfall. Russia-Ukraine is one big pitfall. You're going to have 20 other pitfalls in life. China's shaking at the border is a pitfall. Pakistan is, having so many internal problems. They may want to create problems for India just because they want to save their political skins, and the military wants to keep control. So problems, Avni, is bound to be there. But क्या है, हमारा प्रधानमंत्री का एक लक्ष्य है और वो लक्ष्य छूटता नहीं है. He will grow to that target irrespective of what problems there are. And problems are galore for him or for me or for all people in this country. I'm not worried about it at all. Because with his direction in which he's going and the way he is fixed on the objective to do, irrespective of the problems of the country and his leadership and the ideas which he has done. Take one example. The West and East are two blocks. We are able to deal with the West and do business with them. And at the same time, we are buying oil from Russia. And we have saved 35,000 crores in last 5 months because we got oil at lower prices from Russia. Now, that type of balancing that we are able to do at this point of time is extraordinary, Avdi. It's unbelievable. So it's good for the type of leadership which you have. Will we have pitfalls? I'm 100% that we will. But we will get up again and march on and fly.
So Mr. Hiranandani, what are those, risks that you're worried about?
I'm not worried about.
Okay.
It's like we doing a program, we building a project. We anticipate some risks, but there are so many risks which we never anticipated. For instance, when COVID happened, we had to take care of all the labor. We had to stop our construction. We couldn't get the materials. We had problems regarding finances because we wouldn't get installments from our customers, but we still wanted to do the construction. We wanted to pay our labor. We wanted to pay our staff. So all those are problems, but that doesn't mean you can't overcome them or overwhelm them. So we will keep working. We will have problems in life. Who doesn't have problems in life, Avni? We all do, and I don't think anybody or anyone, least of all the Prime Minister of India, will not have problems. But look at the way he handles it. Fantastic. So we're very proud of him. And where will you get a person of that caliber to be able to do it? We're very proud and happy with him. And God bless that we want people who will take the risks of leading the country into difficult terrains and do and target impossible tasks for what he is doing. I mean, we're very proud of him on that. But if you think he won't have problems, or you think I won't have problems, or you think that you will not have problems in life, is something we should never try to even think about.
Yes,
so what
absolutely.
will those problems be? Maybe some we can predict, some we cannot. So like, for instance, the Western countries, recession is on. So obviously our exports will be affected in the short run. The IT industry will have some setbacks for a temporary period. But it's okay.
Yes, absolutely, Mr. Hiranandani. Completely agree with you on that front. But on that very optimistic note, thank you so much for joining us. Pleasure talking to you as always. Well, with that, let's welcome our next guest. We've got Mayur Shah, Partner Tax at EY India, who's joining us on the broadcast. Thank you very much, Mr. Shah, for speaking to us here on Editorji. The big question to you, of course, now the big question that everybody wants to know is, which tax regime do I opt for? How do I decide which one is more beneficial to me? What is your advice?
Yeah, see, that's a big question which we are all grappling with. And the
Yes.
answer to that is depends upon the calculations which we have to carry out. So let us take an example that if we are having deductions or exemptions in aggregate of around 4,35,000, then probably unless you have income above 5 crore, it may not really be helpful. But if our deduction is anything less than that, then it would definitely new regime would be much beneficial. So it all depends upon the how much deductions or exemption I am claiming. As a result, new regime would be beneficial or not beneficial. To best when we just kind of average it out, anybody who is drawing above 15 lakhs to 2 crores, and till such time, it really doesn't make much difference whether you go with the new regime or old regime, provided your deductions is restricted to through 3.5 lakh rupees.
Okay, right. And overall, your assessment of this entire move to the new tax regime, obviously, this was something that was talked about even before the budget. But what is your assessment of this entire push? Do you think this is just a transitionary phase and we are going to see the old regime phased out over the next few years?
So yes, you are right, and it appears that way only because today, when we are making that new regime being a default regime, and there are some finer aspect of this which we all need to note is that when a person is having any business income in his lifetime, he can move opt out once and opt in once. So these are the two alternatives which are available, and thereafter they cannot do anything. They will be only governed by the new regime. However, other than business income person or professional income person can opt out every year, but they have to opt out, and therefore that's the reason why they made new regime as a default regime and old regime, and more likely than not they will phase it out. But of course, next year I don't think they will be doing anything in relation to that, but probably thereafter they will start doing it.
Okay, right. The other aspect that I wanted your perspective on in terms of, the old regime has all of these, exemptions, ATC, ATD, various sections, which is not there in the new regime. It used to have some sort of a forced savings that would come in as a result of that. Do you think that is going to now dwindle down and that, have in effect have a negative impact?
Very difficult to say that because the deductions in all, if on a saving front, what was maximum available was 2 lakh rupees, right? And whether you save it in that or you don't save it, the money is going to be there in the economy thereafter. Because if you have not put it in saving, then you will spend it away. So to that extent, I don't think it has created any impact from a tax perspective. But your question seems to be that in that situation, with rather than people saving money, they would spend that money. And to that extent, yes, there is a risk of that. That people will now look at going towards spending economy rather than saving economy. And I think that's the move they want everyone to carry out. And that's the reason. But I'm just surprised that at one end they are finance minister has also introduced some saving scheme which will be beneficial for women as well as to senior citizen.
Yes.
Given these aspects, I'm just surprised that to have such a move that those deductions in respect of those are removed. So to that extent, it is going to be very challenging. Second thing is that they are putting so much emphasis on social security system, which is being implemented in form of PF and other things. And if you look at Chapter 6A deductions, that is ATC, is mainly comprising of contribution to provident fund. Now, if that not being allowed, and if you are trying to build a stronger social security system, then I don't know, it goes contrary to that. So to that extent, there is a contradiction which I can see in the budget, and that somewhere they should be addressing this.
Right. Obviously, it is going to take time for people to transition to the new system as well, although it is going to become the default system going ahead. So, my understanding of that aspect, Mayur, is that, if you want to choose the old system, the old regime, then you have to make that choice and you have to do that accordingly. But otherwise, if you don't make any choice, you automatically get put into the new tax regime. Is that right?
Your understanding is absolutely right. So, by default, everybody will fall within the new regime. There are 2, 3 conditions which we need to note is that if you want to opt for old regime, before you file before the due date of filing the return, you should have opted out from the new regime. If you don't do it, say you are you are delayed in filing the return, in that case you will be saddled with new regime and you will not have ability to opt out then. So therefore a choice needs to be made before the due date of filing the return, and that's the fine print which kind of makes everyone worry, that if you have not opted out, then you may not be able to govern by that, and that choice needs to be submitted to the tax officer before the due date.
Right. So you're saying that is some clarity needs to come in on that front. Okay. The other aspect is the highest surcharge that's now been cut from 37% to 25%. Again, it's only in the new regime, not in the old regime. The maximum tax rate has been reduced from 39 from 42.7%. If you could just, for our viewers, help us understand how much of an impact is this going to have? How much of savings would this have for somebody falling into that bracket?
Correct. So, as I was saying that, this is more beneficial for HNI.
Yes.
Because, the maximum marginal rate under the old regime was 42.74%, which has been brought down to 39%. Now, what has happened, the people who are drawing income above 5 CR, for them, the benefit would be around 20 lakhs. And that's what is kind of advantage which it offers, and that is really welcoming, because in any part of the world, we have not seen such high rate of tax being applicable to individuals, and only in India we have seen this kind of tax rate being applicable. So this will kind of put us in line with other countries, especially when we were looking at we have introduced citizenship based residency. As a result, there is some issue which are arising now. If we are going to get taxed, if anybody who is working abroad getting taxed at a maximum marginal rate, we will see that a lot of people surrendering their Indian citizenship and moving into the other country, and that's happening. And that's the reason why the steps or measures has been taken to reduce the tax rate as far as people earning income over 5 CR.
Yes, absolutely, Mayur. In fact, those are some important points that you've mentioned there. I really want to go back to the first question, because I know that in this newsroom itself, there have been people who are trying to figure out how to deal with this new situation of the tax regime. What exactly, how does one need to think? I understand that there are all of these calculations that one needs to do to figure out what works best. But if you could just guide our viewers into how one should think about deciding which scheme, which regime to opt for.
See, basically how one really needs to look at it, that if my deduction or exemption which I'm supposed to claim, like HRA exemption, leave travel assistance, or 8IC deductions, in aggregate, if it is below 3 lakh, then probably the old regime would new regime would be better. But if it is above that, then old regime would be much better. If my income is below 2 CR, if it is above 2 CR, then I believe that it really doesn't impact. New regime is always better.
All right.
And we have carried out various calculations basis which my statements are there. And I'm just making it simple that, one has to just look at, if my deductions and calculation is like that, then I should just go for old regime. Otherwise, it is new regime. Very simple.
All right. Fair enough, Mayur. Thank you so much for joining us with that perspective. Hope that gives everybody a little bit clarity on how to approach the new regime, how to decide. Of course, a lot of it depends on what, all the calculations and deductions. So that, of course, we'll keep breaking that down over the next few days as well. But Mayur, thank you so much. Let me welcome our next guest, Mr. Madan Sabnavist, Chief Economist at Bank of Baroda, is joining us here on the broadcast. Thank you very much for joining us. Your first reaction from the budget, the consensus seems to be that it was a very balanced budget on both sides, including on the fisc. What is your takeaway?
Yeah, I think the budget was more or less on lines with expectations. I think the hype which was built over populism because it's a pre-election budget is something which definitely we do not see any signs of that. we all believe that the government has always shown its commitment towards moving towards that 4.5% fiscal deficit number. So that's what we have already seen, that a reduction of 0.5% has been invoked in this particular budget. And this has been the starting point of the budget. So if you look at all the other numbers which we are seeing in the budget, it starts off from this 5.9% fiscal deficit number, combined with the 10.5% GDP growth, which has been projected for the year. So that actually determines as to how your tax revenues are going to grow, because that's linked to the state of the economy. If the economy grows at a faster rate, you'll probably garner higher revenues, which was the case in 22-23. So for 23-24, since there's going to be a slowdown in GDP growth, even the increase which we have seen in tax revenues have been modest. It's more in line with your GDP growth. And besides that, I think there has not been any major surprise as such. I would say that there are certain perceptions, of course, created that there's a lot being given to the salary class. Actually, that could be very, very marginal, because when you're talking of, I was just hearing the discussion we are having with the earlier guest on the income tax rates. We really need to see how many people opt for the new scheme, and what kind of gains are really going to be there, which could push up consumption. So I think those things are just probably certain kind of cleanliness factors which have come into the picture to placate this particular class. But I think what is really significant when the government is really working on is to try and push forward growth, which it has done through the increase in the capital expenditure. So I think that's been very significant. I was not expecting this kind of an increase. I was expecting it to be around 10-15% at most, but they have definitely gone in for a higher number, which is possible because there have been quite a bit of rationalization of subsidies to NREGA expenditure. So I would say that rolling back, or rather withdrawing the kind of accommodation which was provided during the COVID times and persevered also because of the Ukraine war, is something which has gotten them extra resources, which is being used for productive purposes, that is for capital expenditure. So that's the way I look at it. It's a growth-oriented budget. Not to say it's going to bring more rapid growth, but it's going to definitely help in pushing forward growth at a time when conditions don't look that bright. So even though we're growing over 6%, but we are still saying that what the government does will probably add to the overall investment of something like 90 lakh crores, which is required, or which we are forecasting for this particular year. You're contributing to around 10 lakh crores.
Absolutely. Mr. Sabnawis, anything that you were disappointed with, or that you hoped we would see this budget, but which didn't come in?
No, I was really expecting some kind of fillip to be provided to savings. It's come in a very, very minor way, because I think one of the problems we have had is that financial savings have been coming down in the economy. People are going more towards the equity markets. That's both direct equity as well as mutual funds. And we thought that some kind of parity would be created for bank deposits, because if I keep my money in a mutual fund, say debt fund, and I keep it for 3 years, I get also an indexation in terms of the capital gains. Whereas if I do the same thing in terms of bank deposits, I don't get any such benefit. So I thought this kind of parity was something which was required, and probably enhancing the limits under ATC so that you're able to encourage more household savings would have really benefited individual taxpayers. Similarly, for housing, while a lot has been done in terms of the Awas Yojana, which is, of course, good, but I think logically one should have also expanded the exemption or the deductions which you can claim on terms of interest on home loans, because that has been stagnant for a very long time. So I think these kind of things to prop up savings could have also been accommodated in the budget. But as what happens almost every time, the finance minister would rightly say that hands are tied, because you only have so many resources. And especially if the economy is slowing down and the resources are not going to grow at the same pace as earlier, you will have to cut down on certain benefits which could be given. Though unfortunately, it always happens that the salary class is the one which bears the brunt out here. But I think the compensations are that there is something which is happening on the capex side, which is required also for economic growth.
Right. I'm glad you mentioned the savings perspective, Mrs. Sabnawis, because that was one question that I've also had, ever since the new tax regime came in. Now with the push towards a new tax regime, it becoming the default tax regime, the savings, a lot of them forced under the old tax regime, will all go away. Do you think that even though India has been historically a high savings society, do you think that could further hinder or impact the kind of savings we do as a country?
The prima facie does appear it will affect savings, because, for example, once you do away with with these exemptions or these deductions which we are talking of, it will automatically mean that normally people do go in for life insurance policies, and I think the life insurance stocks took a down dip on account of the budget, because that's the first sector which gets affected, because normally when you have that buffer of 1.5 lakhs to invest, you normally tend to put it in your provident fund, pension funds, and LIC. Pension funds, of course, I think it's a separate allowance which is there. Now, definitely LIC will become less attractive, because earlier we all knew that LIC was never good an investment option. It's only effective in case something negative happens to you in life. So today, but the tax benefit is something which actually kept people investing in their life insurance. But that will definitely go off today. And in this kind of a situation, I think overall financial savings could tend to get affected. And I think the problem really happens, is when money goes into the equity markets. Because if I put directly into equity, which is what lots of households did at the time when interest rates came down to very low levels at some bank deposits, because that doesn't really add to any kind of contribution to capital, to capital formation. When you put in a mutual fund, you put in a debt mutual fund, yes, they're going to invest in certain bonds. But if it happens in the secondary market, then there's actually no benefit for the economy as such. So I think that we will have to wait and see how this works out. But I think there will definitely be an impact on overall savings, which are already being dampened today because of high inflation.
All right. And the other question I had was with respect to, how bolstered are we really from, the global recession going forward? Because obviously there is a lot of optimism, India being the fastest growing economy, but any downside risks, and how cushioned are we really?
See, when we started off in 2022 itself, there were a number of global disturbances. And I think going by the way in which the Indian economy performed, at least statistically, we came up with 7%. See, I'm a bit cautious of talking of this fastest growing economy and 6% plus, because I think where we have really reached a situation where we were in the pre-pandemic stage. So we had the problems of lower consumption, lower job creation, low private investment. And these problems are very much there even today. It'll take a long time to resolve them. So one can be positive about that. But yes, these problems are still there. But the fact that in 2022, which was a tough year from the global perspective, we had high global commodity prices, we had the war in Ukraine, we had the China factor coming in, trade getting disrupted all over, we still did perform well. So I think we are immune to the global recession in real terms. When I say real terms, in terms of overall growth, primarily because we're a domestic-oriented economy. So how much ever we would like to say that we are a part of global supply chains, so on and so forth. But the fact remains that once you get more integrated with the global economy, which is what we are aiming to do, you become more vulnerable to what happens internationally. But today, since most of our demand comes from within the country, so there is a certain amount of economic growth which we can always take to be assured. And that's what we're seeing today. So we, of course, do get affected on account of the recession in terms of global trade. So our exports are going to get affected. Probably our software exports are also going to get affected. They haven't been affected so far. But if the recession turns out to be deeper in the West, I think that would also be a point of concern for us. Similarly, we don't know how the foreign investment flows would behave on account of the recession. The positive side, one says that if interest rates are going to start coming down in the West, then there is hope for us as investors will start coming to India once more. So that's something which we have to wait and see. But I think a lot of comfort comes from the fact that we are a domestic-oriented economy, that even though there is a recession in the West, while we will be affected at the margin, it may not be that deep-rooted. And there is some bit of buoyancy which is there because of the nature of being domestic-oriented.
All right, Mrs. Abnavis, thank you so much for joining us on the show. Thank you for joining us on that note. Let's listen in to what the Finance Minister said earlier today.
Energy evacuation. The interstate transmission system for evacuation and grid integration of 13 gigawatt renewable energy from Ladakh will be constructed with investment of 20,700 crore, including central support of 8,300 crores. In the 75th year of our independence, the world has recognized the Indian economy as a bright star. Our current year's economic growth is estimated to be at 7%. It is notable that this is the highest among all the major economies. This is in spite of the massive slowdown globally caused by COVID-19 and the war. The Indian economy is therefore on the right track. The per capita income has more than doubled to 1.97 lakh rupees. In these 9 years, the Indian economy has increased in size from being 10th to 5th largest in the world. Electronics, as a result of various initiatives of the government, including phased manufacturing program, mobile phone production in India has increased from 5.8 crore units valued at about 18,900 crore in 2014-15 to 31 crore units valued at 2,75,000 crore in the last financial year. To further deepen domestic value addition in manufacturing of mobile phones, I propose to provide relief to customs duty. I propose to provide relief in customs duty on import of certain parts and inputs like camera lens, and continue the concessional duty on lithium-ion cells for battery.
Anand, for speaking to us. The big question, of course, that has been going around since the changes in the slabs came in is, how do I decide which one is right for me? What is your advice at this point in time?
Hi, firstly, thank you so much for having me on the show. I would just like to simplify everything in 3 simple points. Firstly, right now also majority people are filing their income taxes through old tax regime. If you are in old tax regime, there is not much of benefit which is there for you. And if you want to decide whether you should switch to new or you should stick to your old tax regimes, answer is very simple. First, if your income is in the slab of 5 to 10 lakh, max 15 lakh, new tax regime is obviously favorable for you. If your income is above 20 lakh and you are properly taking all the deductions and making sure that you do it tax efficiently, then old tax regime is still favorable for you. So it will be completely dependent on 2 points. Firstly, what is your income slab? That is, what is the amount of income which you are disclosing. Second, how efficiently you are using deductions. If you are using it efficiently and your income is above 20 lakh, old tax regime is still favorable. If you are a new taxpayer and you are thinking to pay tax for the very first time, obviously new tax regime has a lot of benefits and you should opt for new tax regime.
Right, but then how does one look at, the savings, all of the deductions that are available under the old tax regime? A lot of it were forced. I mean, come tax filing time, you rush to make those investments under ATC and try and get those exemptions. But what should the process then be?
See, if you are in old tax regime, best way to claim ATC deduction is to plan it in advance. You have to obviously plan it in advance and you have to ensure that by 15th of March each year, you are sorted with all your deductions and you are properly taking care of it. And it is not only about ATC deduction, it is also about other deduction and other allowances. You have to ensure that you are properly sorted for all your deductions and you are not wasting your money in the end in some wrong policies and getting stuck out there. So you have to obviously plan it in advance. And as we always say that if you fail to plan, you are planning to fail. So better plan.
All right, fair enough. Now you gave us 3 bullet points of, how to sort of look at the new tax regime. But in terms of somebody who's assessing, somebody who say has a home loan or who has a PPF, and is making use of those ATC, deductions, does it make sense for them to switch to the new tax regime or continue with the old tax regime? How does one sort of make those calculations?
If you already have your deductions in place, then obviously old tax regime will still be more favorable. Best way to do is let your CA do the task for you and give you comparison between both the tax regime and what is the tax payable in both the cases, and then you choose accordingly. My only point is, if you have deductions in place, old tax regime will still be more favorable for you. Right now, government is favoring new tax regime a lot, But as the data is suggesting that even last year, less than 10% people shifted to new tax regime. So obviously there is some benefit in the old scheme, which all of us can easily use, and we should stick to that.
Right. But now, of course, the new tax regime has become the default tax regime, as the finance minister said. So if you want to choose the old one, then you have to specifically do that. Otherwise, you will automatically be moved to the new regime. So do you think that this is also going to see a whole host of new influx into the new tax regime system?
Yes, especially for the new taxpayers, I think they will be preferring new tax regime more as compared to the old regime. And what this complete system has done is, in simple words, I'll try to explain. In government is ensuring that you have some extra cash flow in hand, but at the same time is not promoting investment, because investment is obviously promoted when you invest in probably ELSS or maybe some instruments, just because you want to save some deduction and some taxes and take deduction in ATC. So I feel somewhere government is letting you have some extra cash, but at the same time not promoting investments. Had government promoted investment, they should have increased limit of ATC by at least 50,000 or 1 lakh. So this is a case which we have to make sure of.
All right, Anant. Thank you so much for joining us with that perspective and all of that advice. Hope our viewers have at least got some indication of how to sort of assess which tax regime works for you. Like Anand said, best to go to your CA, work out all of your deductions, what investments you have, and then make that educated call of which one to opt for. On that note, it's a wrap from me here at on the special coverage of the budget 2023. Over the next few days, we'll continue to break down the fine print, the impact on you, on your savings and your investments. Until then, thanks so much for watching.
Thank you.